Hey guys, what is going on? Welcome back to the channel. Again, I want to thank everyone for your support on the channel. If you guys do like the content, if you guys do like the video series, feel free to like, share, and subscribe. And if you are a subscriber, make sure to hit that bell button to get alerts and updates on all new content posted on the channel. For today's video, I thought I'd go into an investing strategy called market timing. There's been a few viewers on the channel, new viewers, new subscribers asking, why don't investors simply sell off their stocks before a stock market correction, before a stock market crash, to preserve their capital? And why do investors hold on to stocks that start trending down in price? Why don't they simply sell those off to buy back at a lower price at a later date? So I thought I'd kind of go into that, especially with the portfolio here yesterday and the day before dropping quite considerably. We'll talk about that stock a little bit later in the video, Portola. But I thought I'd kind of start the video off talking about VYM here. This is a very large Vanguard fund. If we look at the bottom here, you can see this is a Vanguard high dividend yield ETF, tracking a very broad market representation of high dividend paying U.S. companies. Simply, this is tracking the overall market. If we take a look at the one-year graph here, you can really see the performance was doing quite nicely here. At one point up 15.69% or so over the past 1 year. And then you can see this very big pullback in the price of this stock. Again, this is representing the entire stock market here for the most part. And you can see it dropping from 17% in the green down to 9%. So a very significant correction in the market. Again, this is kind of a surrogate measure for the overall market, VYM here being a very broad-based index fund. So market timing would simply be a strategy where you would sell off in this area here, maybe at $89.53, maybe even getting up here at almost to $91, 90 and 91 cents. You would sell off, and then after the stock drops here, you would buy the stock back at a very low price. So essentially make a very good trade by selling high, then buying back at a lower price. So why don't most investors do this? Well, it's virtually impossible to time this kind of drop here, because really this drop is representing a very broad sell-off in the price of this stock. Again, this stock representing the entire stock market, a very broad sell-off of the entire market. So it's almost impossible to predict that, and it's really what traders are doing as a whole. So if a few traders start selling a few stocks off, you don't get a correction, you don't get this big kind of drop here. You have to have a very significant portion of the market selling stocks off. So if everybody could market time, you would essentially have a flat line here. There'd be no trend up here. There'd be no trend down because everybody would be doing the exact same thing. But that does not happen. So the first key point to make here is that you can virtually never time this. Yes, there's a few things that will happen that maybe you would have a leg up on other investors, but there are virtually thousands of professional traders out there. You'll never get a leg up on those folks. So the kind of trading that I do here, I'm never going to be able to out market time trading professionals here. So it's virtually impossible for a retail investor like myself, really anybody on Robinhood, to time this in a very consistent basis. Yes, you could sell off here and the market could drop, but that'd be more of a coincidence and luck than anything else. And you can certainly not do that consistently over time. So that's why market trading, market timing does not work. You can't put your money, for example, into the market here or into the market here, and then in a very reliable fashion, sell off at a high point and then buy back at a lower point. It's virtually impossible to do. So again, VYM here is serving as a surrogate market for the overall market. All market segments are represented in VYM here. So you can't really time this to sell off here and then buy back here. What typically would happen is maybe you can do that once or twice, getting somewhat lucky, and then you'll go ahead and buy all your stocks here, and then the market drops, and then you'll have a very big loss that you'll have to hold on to the stock for quite some time. That's why I always advocate doing a very planned types of stock market buying. So whether you do dollar cost or value cost averaging, and I've done videos about this in the past, you simply put your money in at a very regular basis, regardless of what the stock market is doing. For dollar cost averaging, value cost averaging, it's a little bit more sophisticated way of putting money into the market, but you have to put money into the market consistently over a long period of time. Market timing does not work. Buying at this point here and then trying to sell off at this point here, you can never do that consistently over a long period of time. So if we go back to Portola as well, so this particular stock, as I have detailed in my prior videos, fell quite dramatically. Let's go ahead and take a look at the 1 week graph to really see this kind of drop off here. You can see it was trading consistently here $45 to $43 or so, and then it dropped off here, getting down, I think, below 30 at one point very briefly. Did trend up here quite nicely today. I'm up, I think, $3,600. No, actually, I'm up $4,200 today because of the rise in the price of the stock. I decided to put a little bit more money in for a swing trade, but you can't really time this drop either. So what accounted for this drop was some information was relayed through a conference call or an earnings report that was not put in any other type of document. It was not put into any filing by the company. This is simply something that would happen live in after-hours trading. During the conference calls, basically, the CEO and CFO and a number of other executives will discuss the business operations with a number of analysts at a meeting. Analysts are free to ask questions to the company. And it came out that the drug that was hopefully coming out early this year, mid-2018, at the latest, early 2019, now may be requiring a very large and expensive study before it will get approved. And because of that, during that live conference call in after-hours trading, the price of the stock automatically dropped down here because of some very negative positions by the company. A lot of investors do not feel confident in the management of that company now, and this all happened within a couple-minute time frame. So from the end of trading on the 28th here until the start of trading, this stock dropped quite considerably just because of that earnings call, and this was not anything that could be predicted. Yes, the price of the stock was trending down here a few percent before that earnings call, but if if professional traders were able to predict this kind of movement, the stock would have been trending down much, much earlier than it did. This all happened during real time, during the conference call. Some very surprise information came out, and the price of the stock tanked all the way down. So as you can see here over the last 1 year, that's what accounted for this big rise in the price of the stock. The FDA approved one of their drugs, shot up because really the FDA had some negative comments before the approval. So a lot of investors did not think that was going to happen. So this caught the market by surprise in that big jump. And again, this big pullback here as well, right on the end of the screen here, was also a surprise to the investment community. And because of that, the price of the stock dropped so considerably. And again, you can't really market time this. You can't really predict this before it happens. And again, large institutional investors really drive most of the market. So you can never essentially out-trade these sorts of individuals. They're going to have the information before you do, and they're going to be putting in their orders before you have the chance to do that. So market timing, unless you get lucky or try to guess on a particular outcome, you can't really have any confidence in the trades you're making. And another one I want to talk about is LB brands. I've done quite a number of videos about LB in the past. I don't currently have it in my portfolio, in my watch list down here. So this is another stock, very interesting. I don't think you could really have predicted what's going to happen with this stock. So you can see earnings here. Q4 earnings just came out. It actually beat its expected EPS there. Expected earnings $2.01 with earnings of $2.11 per share. But we can see here the price of the stock for the past week has tanked 11.2%. You can see here dropping from $49, almost $50.10 down to $43 initially, and then trending down here over the next day or so down to $43.35 currently. Again, you could not really predict that price change. Apparently, yes, it did beat its earnings, but it has a poorer than expected outlook for the next couple of quarters. Because of that price, or because of that information, the price started dropping because, again, a large number of institutional investors started selling the stock off really before any of the retail investors could get any of their orders placed. So, again, very difficult to time the market. And really, if you are a retail investor, if you do have the stock after the stock starts dropping like this, there's really no panic to go ahead and sell off your stock because, again, you can't predict what's going to happen next. If the stock drops to this point, you can't really predict any of this information here. This stock could just as easily have gone up if this last earnings report had a better than expected next couple of quarters, along with the earnings beat here in Q4 2017. So it's very difficult to predict any of that information, and definitely impossible to predict on a consistent basis over time. So that is why market timing does not work. You cannot ever really predict what the other large institutional investors are going to do with any particular stock that they hold. Again, the stock price dropping from, for example, $60.48 down to $47 takes a lot of movement. A few retail investors selling off the stock is not going to produce this. You need the large institutional investors selling off a significant portion of their stock to have these types of a stock. Again, Portola, the perfect example because of that large decrease yesterday during that earnings call where some information, negative information, was relayed for the first time. Before that, there was no hint that that information was going to be presented at that meeting. So I hope that kind of explains why market timing is not possible. It's virtually impossible to do consistently over the longer term. Yes, you may be able to do it once or twice, but over the longer term, it's really just gambling, and there's really no need to do that. If you utilize dollar cost averaging, value cost averaging, a number of other investment strategies, I think you'll have a very, very good return over time, much better than trying to put all your money into the market, say here or here, and then trying to predict the market behavior in the future, trending up. If you buy down here, buy low, sell high, or trending down here, selling off here, and then buying back when it's at a lower price. You can't really do that on a consistent basis over time. So I hope that answers the questions of those few viewers, new viewers on the channel, wondering why more investors don't kind of sell off before market corrections. Again, if you take a look at some of the news, yes, they've been talking about a market correction over the last couple of weeks, but if you really go back over the last year, they've been talking about a correction since like 2016. So when do you jump out of the market? If you would have jumped out of the market in 2015 or 16 or 17, you would have missed 20% gains over the last couple of years. So you can't really do that. You can't really do that on a consistent basis. Again, unless you know some inside information, virtually impossible to do this over a long period of time. So don't want to make the video too long. Just wanted to respond to those few viewers wondering why that happens in the market. If you guys have any questions about this video, other videos, again, please let me know in the comment threads down below. I'll do the best I can to get back to you guys as quickly as I can. So yeah, kind of with that, I'll end the video, and we'll see you guys next time.